Up to 8 billion shillings worth of recovery of bad debts has been made on National Bank's loan book ever since the takeover by KCB Group in the fourth quarter of 2019. I sat down with KCB Group's Chief Financial Officer to unpack this and more in the group's full year 2019 results. Well, Lawrence, just talking about NBK, 5 billion shillings later, do you still feel that this was a good investment for KCB, especially looking at the performance for the full year 2019?
NBK has a lot of potential. The reason why we went after it is we saw opportunity. We saw opportunity on top line growth. We saw opportunity on synergies of costs. And when we acquired the NBK, they were sitting at about cost to income ratio of about 95%. And then the last part was just writing the book, getting the asset quality in the right shape.
Looking at the non-performing loans book, which clearly we have seen has gone up by about 93.8%. What actually explains this significant surge?
You remember we just acquired NBK quarter 4. So the 6.7, 6.8% performance in 2018, that is only KCB. The 10.9 NPL in 2019 is inclusive of NBK. So it's really not a like-for-like comparison. Had we consolidated the NBK in 2018, we've actually come from 12% to 10.9.
The profit after tax is up by about 5%. And when I look at these numbers, what I'm scouting for is the growth story in KCB. Where would you say to convince shareholders that actually there is a growth story in these numbers for full year 2019?
In 2018, we delivered about a 13% growth, but the shape of the profit and loss was the growth came from the middle part, cost cutting, and obviously because 2018 was the first year of the IFRS 9 implementation, the provisions on loans was lower than would have been in a normal year, and that delivered the bottom line. If you look at the 2019 shape, the performance is coming from top line.